ever wondered what truly connects traders from Tokyo to London to New York? You just need to learn the language. That language is technical analysis. Understand its signals, and you'll understand the world. Welcome to Traders of the World. Here we skip the jargon and just figure it out together.
Ever wondered what truly connects traders from Tokyo to Mumbai to New York? It's not English, it's not Mandarin, it's the charts. Technical analysis is the only universal language of the markets. Understand its signals, and you understand the world. Join me, Flavio Lemos, on Traders of the World as we decode the global conversation. Stop guessing, start understanding. Hello, traders, and welcome back to Traders of the World. For such a special case, I'm not alone. I'm so pumped to be joined today by the only Rafael Figueiredo, better known as Rafi. He is an equity strategist at XP with 20 years of professional experience. He has built his career as a strategist and a market analyst. And before joining XP in 2025, he served as a chief strategist and CEO of 11 Financial Research. He specializes in intermarket analysis, sector rotation, and trading ideas, providing strategic insights that directly impact investment decisions for investors and especially firms. It's great to have you here, Rafi. Let's get into it.
Yeah, it's great to be here, Flavio. Let's get into it.
All right, and before we dive in, as we got started with today's very special interview, if you find value in what you hear, please help our channel grow by hitting the like button, subscribe, and share your key takeaway in the comments. Your engagement makes a real difference. And today, we have one of the chief translators of that language. Our guest is a true macro detective, a master at connecting the dots between stocks, bonds, currencies, and commodities. He is the president of Bianco Research, a CMT shareholder, and a voice you have seen and trusted for decades on every major financial network from CNBC to Bloomberg. He is here to unpack the market's DNA. It's absolute an honor to have Jim Bianco on the show. Hello, Jim. Welcome.
Well, thank you. I appreciate that introduction. I'll have to show it to my wife to convince her that I'm a legitimate person.
Okay, Rafi, shoot you on.
Yeah, well, nice to have you here, Jim. So talk with you. We're here to all the traders all around the world. So, Jim, you've been in this game since '80s, right? At the big firms like First Boston and also UBS. So now you are a CMT like ourselves here, but while many techs get obsessed with just stocks, you became a guy for fixed income and macro and global macro. So how did that evolution happen? And what made you look beyond equities into deep and fascinating world of FICC?
So you're right. I mean, if I was to trace back in 1987, I started working at First Boston. I was there right after the stock market crash of '87. I was one of the first, people hired. My first day there was November 2nd, 1982. So I was literally 2 weeks after the stock market crash of '87. And I worked for the technical analyst named Joe Generalis at the time. And, so I kind of cut my teeth with technical analysis. And eventually Joe got me involved with the fixed income side. So the 7th floor of First Boston back then was equities, and the 6th floor was fixed income. And I was spending more and more time with the guys downstairs in fixed income. And I was becoming more and more interested in the bond market, in the commodity markets, in the currency markets. And, I was spending, doing less time with sector rotation and what was going on in the stock market. One of those clients down on the 6th floor was a firm called Arbor Research Group, which was from the Chicago area where I am and still am to this day. And they recruited me out of there back in 1990. so 35 years ago. And I went to work for them. And through them in 1998, I spun myself off as Bianco Research. They are the second largest shareholder of my company. I'm the largest. I am still the third largest shareholder of their company. So we've got this relationship now going for about 35 years. And from there, I started working on doing, fixed income analysis. And that kind of naturally led you to macro, because that seems to be really what drives the big picture with fixed income, with currencies and the like. Whereas, the idiosyncratic things of earnings and company and strategy seems to drive individual stocks.
Nice.
I want to rewind your presentation from April 2022, when we were together at the CMT Association Symposium at Washington. Back then, transitory was still the word of the day, but your charts were flashing bright red. You showed inflation hitting 8.5, I think, and the bond market having its worst start of the year ever. You were sounding the alarm before it was fashionable. What were you seeing in your intermarket work that gave you that much conviction? And if you have some charts to show it, we'd love to see it.
Yeah, let me see if there's I got a whole bunch of charts here, but let's see if I got one that would work. I might, but let me answer your question. I have always said, when I look at the market, I believe that markets are more cyclical than secular, and that they constantly have events that cause the cyclicality of a market to change. So coming out of 2020, I was of the opinion that what we just witnessed with the shutdown restart of the global economy was the biggest economic event of our lifetime. It was bigger than the financial crisis of 2008. It was bigger than the tech bubble of 2000. It was bigger than the 87 crash. It's bigger than the 74 market if you're old enough to go back that far. Mm-hmm. And what I've operated under is when you have these big overarching events, and they're usually around financial crises, and we definitely had one in 2020. The Fed had to step in and buy at one point $100 billion of bonds a day to try and stabilize the bond market, and a recession. And we had the worst quarterly recession ever in the United States history in the second quarter. That those kind of shocking events changed things. It changed the economy. And now change, there's one of my older charts. Change is
I remember that.
Yeah. Change does not mean worse. I want to make sure that I understand that people say, I did say it's worse, said it's different. And so the economy coming out of 2020, I thought was different. And the first thing I thought was going to happen was all of this turmoil is going to lead to higher inflation. And all of that inflation is going to be something that is going to be a bigger problem than what we've been used to. And there you can see that the inflation rate started to move up by by April of 2020. And that was going to end the 40-year bull market in bonds. And the 40-year bull market in bonds did end during that period. And we saw one of the biggest rises of rates that we've ever seen. Let me see if I could share my screen here. Where's the share screen button? Did I hit? Let's see here. So, yeah. So here is what yields have done since 2020. You could see this, if you can see this chart here, and I can illustrate on it here. So what you're seeing is in 2020, that yield low, 51 basis points in the 10-year yield, is the lowest in American history. By October of 23, it had gone from 50 basis points to nearly 5%. That 3-year period produced a 20% loss to any bondholder that held them. That is the worst 3-year period in 160 years of owning of the bond market. There is data that goes back into the 1790s on the total returns of bonds. So what I've argued is you had a life-defining event that if you are a bond trader or you are a fixed income investor, this 3-year period is going to be the definition of your career. There was what happened before it and what's going to happen after it. But that was the career, and it was all born out of 2020. We changed the economy. We had deglobalization. We had remote work. Now we've got tariffs. You add it up, and we're in a structurally higher inflation regime. I think we're in a 3 to 4% inflation world. I drew a couple of trend lines on this chart, and I said, after that big, epic move, we've spent the last 2 years digesting that move. Now, this is a pennant pattern that I've drawn right here. And typically, pennant patterns are continuation patterns, meaning you went up into it, you consolidate that move, you will break out in the direction you went into it. In other words, the market's trend will continue higher. Pennant patterns can be, but most often are not. You go up, you go sideways, and then you reverse. They're usually not reversal patterns. They're usually continuation patterns. So that's the big picture I've been operating under. This economy, and the guy that I've been most critical about is Jay Powell. 2023, 2024, he used to say, we're seeing broad signs that the economy is normalizing. We're seeing signs we're returning to pre-pandemic levels. And I would scream at the TV when I'm watching his press conference, that was the previous cycle. That cycle is over. We're not going back there again. Now, that doesn't mean it's worse. That just means we're going somewhere different. And for now, that somewhere different is leading to higher levels of inflation. 3-ish inflation, as I said. Not 8, 10 Zimbabwe inflation, but 3% inflation. And to put that into perspective, the way I look at it, 3% inflation means that the funds rate, neutral funds rate, should be about 4. It's 3.75 right now, which means the 2-year note should be about 4.5, which means that the 10-year note should be yielding in the low 5s. Well, as this chart shows you here today, the 10-year note is yielding 4.12. So I think it's going to move up higher out of this range over the next several months or so. And I've been saying that for a while, but what's been happening is we've been just consolidating into this range, but now we're getting to the kind of the end of the pennant here, and something's going to have to give one way or the other when we decide which way this market wants to go. So that's the big picture of where I'm going with. We fundamentally changed the economy 5 years ago. We are now in a secular or a long time bear market with a cyclical up push in interest rates. It might turn into be a secular bear market. We finished the 40-year secular bull market in 2020. We are going to continue to be in an era of higher and higher and higher interest rates.
Nice. So let me follow up a little bit about here, and let me ask you this this question, because I've been following your work and I've been watching your videos and your analysis, and you always saying about the recession things. You got right about no land camp, and by the way, you were the only guy in America that was saying that you were a no landing camp. I remember that because everybody was in very inflationary period, in recession period, and the other guys would say, okay, there is no problem here, and you were like, the economy's already changed, and of course we are in no landing camp, and you got it right. So, but at the same way that you were telling us about your no landing camp, your concerns about the recession, you were always saying that something has to break or something has to change dramatically to that we can see the recession is happening. So my question is, maybe the bond markets already changed, or maybe the signals of something has to break. It's that we are seeing it's on 10-year yield or the bond markets. Do you agree with that? So we definitely have a big change and about 640 portfolio that doesn't work anymore. So that's my point. It's correct that the bond market's already changed, right, from now on.
Yes. So let me start off with the first part of your question by sharing my screen again. Here, let's see if so. There was an economist named Rudy Dornbush who worked in the 1970s at MIT, and he made this famous line: "Economic expansions do not die of old age; they're murdered." And what he means by that is that the natural state for a capitalist economy is to grow. It will grow forever. What, did I just say no business cycle? Not exactly. There are business cycles within individual industries. Currently, the office real estate market is in a terrible recession, but the data center real estate market is booming out of sight. So we have these self-corrections, but the overall economy continues to grow because you continue to self-correct along the way. What a recession is an exogenous event, and here is all the recessions: the start date, the end date. These are all the recessions going back to the end of World War II. Let me try that again here. The start date, the end date, and you could see the period or the reason that you had the murder of the economy. And I've often said that during those periods, that what you will see is that the economy grows, but you have to look for some kind of an event that comes along and scares everybody so that they stop doing economic activity. COVID, a global shutdown was that. Now, since 2020, I would argue there were two possibilities of a recession but neither one happened. It was 2023 when Silicon Valley Bank failed. Oh my God, we're going to have a financial crisis. And that's going to lead to a recession, but it didn't. And it was earlier this year when we announced Liberation Day with all the tariffs, and the stock market fell 19% in 2 weeks. It didn't. So I've been arguing that why I've been in the no landing camp is I've said, look, if you're talking about a recession, you got to give me a murder weapon or a trigger. Something has to happen to trigger it. And usually those things are very abrupt: a shutdown, a war, some kind of political crisis. Short of that, the economy muddles along. No landing. Added to that, higher inflation. And my biggest concern is higher interest rates, not lower interest rates. And that's why I've been arguing that. So when people say to me, well, what about the signs that there's going to be a recession? Well, look, the economy can grow slow. It can grow fast. But if it's going to contract, that means that people are willingly not going to the store, willingly not doing economic activity. Why would they stop doing that? And the answer is, well, if they lost their job. But the unemployment rate's 4.3%. It's not, there is no massive unemployment in the United States. Sales at the stores is not slowing down. It's going to be something that is like a big red headline on your computer that dominates the news, that gets everybody to be scared out of their mind to stop. We don't have any of that. So that's why my bigger concern has always been no landing, higher inflation, higher interest rates. That's what I've been always concerned with, that we don't murder the economy at this point.
Speaking of the rates, there is always a political noise. We have recently seen demands for the Fed cut rates. You have made the counterintuitive case that this kind of political pressure can actually lead to higher long-term yields. How does that plumbing work? And even more, what's the fair value of the bonds right now?
So a couple of things about that. And this is going to kind of get in the weeds of a little bit of Fed watching as well, because I've been arguing too that, and I'll show you this chart here. I've been arguing too that we've got a big major change going on with the Fed. Currently, this chart's a couple days old, but we're still at about that level. I'll look here right now, and yeah, we're still at about this level. You've got about a 50-50 chance that the Fed is going to cut rates at its December 10th meeting. 50-50, 50% chance they're going to cut rates, 50% chance they're going to hold steady. Let me restate that. The day we're recording is November 18th. We're talking about a meeting in 3 weeks. The market has not made up its mind as to what the Fed's going to do. That's unusual. That almost never happens. By this point, 3 weeks before the meeting, it's either trading with a 100% probability or 90-ish% probability the Fed's going to move rates, or a 0 to 10% probability the Fed's going to move rates. So it's made up its mind what it's going to do. It currently has not made up its mind. Now, why hasn't it made up its mind? Because something is changing at the Fed. This is something I've been writing about the last couple of days. Donald Trump's incessant Fed bashing, Jay Powell is terrible, he wants to get rid of him. 2 hours before we were recording, he was in the White House saying he would like to fire Powell today, but he knows he can't fire him today, right now, has led to, and he said he's already made up his mind who's going to be the next Fed chairman. And he didn't say who it was going to be, but he did say his first choice is Scott Bessent, but Bessent doesn't want the job. He wants to stay at the Treasury Department, at least for right now. And so what that political pressure has done to the Fed is it's changed the way it votes right now. So what I would argue is that normally the way we all been watching the Fed our whole career is that the Fed basically does what the chairman wants. If the chairman says we're going to cut rates, they all fall in line, they all vote for it. If the chairman says we're not going to cut rates, they all fall in line and they all vote for it. Well, something happened last week. Last week, Monday, we started the week at 70% chance the Fed was going to cut rates, and we've gone to 50%. But in the last 8 days, 8 trading days, last week, Monday, Tuesday, 17th, 18th of November of this week, we've gotten no real data because the government was closed for most of that, and the Fed chairman hasn't given a speech. So why did we go from 70 to 50? The answer is what we're doing is we're toting up all of what the voters are saying right now. And right now, we've got 5 voters that are saying no move. We've got 4 voters that are saying cut rates, and we've got 3 that we don't know about right now. So we're looking at like a 5-4-3 vote. Normally, the Fed votes 11-0, 12-0, 11-1. And so what I think the market is doing is it's starting to realize doesn't matter what Powell thinks. It matters of how do you get this group of 12 to 7? 7 of them agree on something. 5 of them now say they don't want to move rates. 4 of them say that they want to cut rates. At a minimum, we're going to get 4 dissenters in that meeting in December. But if these 3, one of them is Powell, by the way, if these 3 that have not come out, that's Lisa Cook, Powell, and Jefferson, the chairman, Powell, the vice chairman, Jefferson, and one of the Fed governors, Lisa Cook, we don't know how they're going to vote. But if they go all for a cut, then it'll be a 7-5 vote. If that one of them doesn't go for a cut, then it could be a 6-6 vote. And that's the reality that we think we're starting to see. And that's why the market is stuck at 50-50. It honestly doesn't know what the Fed's going to do because the Fed honestly doesn't know what it's going to do because the game has changed. It's no longer wait for the chairman to tell everybody how to vote and everybody falls in line. Now, if I'm wrong and we get a 12-0 vote or an 11-1 vote, what that would tell me is a lot of people said, I'm not going to move rates or I'm going to move rates and then caved and voted the way that the chairman wants. They're going to have a reputational problem. And I don't think that they're going to do that. I think they made those statements because they intend on voting that way. And why is it change? Because this is the pushback to the political pressure. The president correctly said the other 11 people on the Fed don't matter. All that matters is the chairman. That's why I've been talking about firing Powell and blaming Powell and calling him too late and all these other things and all these other terrible words, because he's the only guy that matters. And I'm going to replace him. And the rest of the board is saying, no, we're an independent body. Maybe we should start acting like it. Maybe we should start voting the way that we think should be the vote, not waiting for the chairman to tell us what to do. So ironically, Trump might have overdone it. In the process of bashing the Fed so hard and so consistently, he might put his new guy in place, and his new guy might say, we're taking rates to 1% because that's where Donald Trump wants them, and I'm going to push and make sure everybody does it. And the 11 voters are going to say, you don't have the votes because we're not going to vote with you. That's the way every other central bank works. But the Fed has not worked that way, and it could be changing right now. So that could be a big change for the Fed right now. So we're at 375. It's possible that we're going to stay at 375. And I think that if we stay at that level right now, that is around where the fair value is, and that's where the rates should be.
Yeah, nice. So for your whole methodology, it's about unpacking the intermarketing relationship. It's the same as I love this intermarketing analysis and taking commodities, bond market, currencies. So for our audience, how do these markets talk to each other, and how does the spike in commodities or a plunge in the yen can translate into a signal for stocks or other asset classes? And most importantly, what are those relationships screening at you right now? Is that gold?
Yeah, so there's a couple of relationships out there. Let me see if I've got that chart here. Hopefully I do. Let me see here. Yes. So let me share this chart with you right away here. This is this funky chart is the stock bond correlation.
Olá, espero que esteja gostando da entrevista. A Trader Brasil foi eleita por 2 vezes no Rank Awards 2024 e 2025 como a melhor academia de formação de investidores do Brasil. E ela tem um presente para você que está assistindo esse podcast. 10% de desconto, é só usar esse QR Code que está aqui embaixo e a gente te espera lá, ok? Agora não esquece de dar uma moral pro Flávio. Curte, compartilhe esse vídeo e se inscreva no nosso canal, ok? Até a próxima e obrigado pela presença. Valeu!
And what I wanted to show, hopefully you could see it right here. This is the correlation between stocks and bonds. This line right here is 0 on the chart. And when the stock bond correlation is above 0, I see the scale I see the scale was cut off of here, but when the stock bond correlation is above 0, what that means up here is that stock and bond prices move up and down together. They go in the same direction. When the correlation is negative down here, that means stock and bond prices move opposite each other. And what you see out of the stock bond relationship is it's going straight north. Here's 0 again, back towards 0. And I think eventually it's going to go positive. What's going on here? Well, when the stock bond correlation is positive, they move up and down together. The argument is the dominating theme in the market is inflation. Maybe you have it, the 1970s, because you can see this chart goes back to 1947. The 1970s, you might have it. So both stock and bond prices go down. Interest rates go up and stocks go down. Maybe in the 1980s, you're relieved. We're worried about inflation, but there isn't any. So you still have a high correlation, but they both go up. Oh, thank God, there's no relation. There's no inflation. Stocks soar and interest rates fall because their bond prices go up. But then starting around 1998, this relationship flipped. This was around long-term capital, the Asian financial crisis, and then down here, in this period down here, the dominant theme became deflation. Now we're worried about deflation. Deflation is the scourge of risk assets. If you have deflation, stocks go down and everybody piles into the safe asset like bonds, their price goes up and yields go down. So yields and stocks go down. When you're relieved, thank God there is no deflation, stocks rally, then the safe asset bonds sell off. So rates go up and stocks go down. They move the opposite each other. So deflation was the concern. During that period, you got risk parity trades, the 60-40 portfolio, because everybody thought this was a permanent state of affairs. We were always going to worry about deflation. So the first intermarket relationship I'll point out to you is that the stock bond correlation is quickly going back to positive. it is quickly reverting to, we're more worried about inflation than deflation. The 60-40 portfolio will not work as it is currently constructed, because it was constructed for a period where we feared deflation, and we're going into a period where we're going to start worrying about inflation. Remember, in the inflation period, it could be the dominant concern is inflation, but thank God there isn't any, so stocks and bonds can rally. But we are worried about inflation is what it could be. So the first intermarket relationship that I've been seeing has been this stock bond correlation. I think this is the start of everything. Then from there, if you say that the stock bond relationship has fundamentally changed, and it's changed because we're starting to worry about inflation, other things start to make more sense. $4,000 gold, $52 silver, that the rally that you've been seeing in those, as I like to say, precious metals are not an inflation hedge. They're a hedge against bad things happening. Maybe it's inflation, which it might be somewhat this time. Maybe it's political strife. Maybe it's deflation, whatever it is. But the reason that gold and silver are rallying, I would argue, is twofold. One, they're rallying because inflation is coming back. Two, the big buyers of gold and silver have been India and Asia right now. They've been buying like crazy. Why? They're perceiving political risk, and it's showing up in the weaker dollar. So they don't want to, when they see political risk and they see uncertainty, their history was everybody pile into the dollar. But it's been weaker. We don't want to buy a weaker currency. We want to buy something that's stronger, and they've been buying gold. And these are not big markets, and they've been rallying quite a bit. So the signal from gold, a high degree of worry is out there in the markets, and it's basically coming out of Asia right now. But I think it starts with this relationship right here, is that the stock bond relationship is starting to change quite a bit.
Jim, I have to ask you about one of my favorite concepts you have put out, Boomer Bitcoin. You posted this,
Yes.
this incredible case shooter chart showing that for 50 years, real home prices went nowhere, just tracking inflation. Can you show us that chart and explain what you mean when you call housing a degen bet that's pricing out the younger generation?
Yeah, so as I pointed out before, that housing is in a boom-bust cycle. And as I said before, everybody thinks that housing is their piggy bank right now, and home prices just keep going and going and going. And everybody owns a home with a mortgage. In trader parlance, that's leverage, right? You put down 10%, you borrow 90%, you're 10-to-1 levered to your house, and the price just keeps going up. And so what I was joking about was that the older generation right now is getting mesmerized by higher and higher home prices. And that's the Bitcoin for boomers. That the average age, as I pointed out, the average age of a home buyer right now, I guess I didn't point it out, but I'll say this. The National Association of Realtors told us that the average age of a home buyer is 59 right now. And the reason it's 59 is you have to be 59 that you've saved enough money to buy a house, because they're so expensive. So boomers are buying homes. Boomers are trading homes. They're very happy with what's happening with higher home prices. Millennials, Gen Zers rent. They're angry that they can't buy a home, but they play Bitcoin. And Bitcoin had been rallying until about 3 weeks ago. And now all of a sudden Bitcoin is tanking. So they're now doubly angry. They're in a crappy apartment. They can't buy a home. And now their main tool that's going to make them rich is going in the wrong direction right now. So that's why I referred to housing as boomer Bitcoin, is because they're degenning. Degenning is degenerate gambling. They're degenning. Boomers are degenning in housing, and millennials and Gen Zs are degenning in Bitcoin.
Nice, Jim. So let's talk about a little bit about your work, your fund, your ETF. So how does it work? And it's basically the way for investors to trade the Bianco brain, and how it's designed to navigate the broken correlation, stock bond correlation, and you've been highlighting for years, and of course today for us.
So as I mentioned in my history, I'm a bond guy from the beginning of time. So I'm most comfortable with the bond market. And I think I understand the bond market more than I understand the stock market as well. Now, let me throw out one other statistic at you. Actively managed funds. Most people believe that actively managed funds cannot outperform an index. That is true in the stock market. The studies are pretty clear that an actively managed fund will, 80 or 90% of them will not outperform the S&P 500. But in fixed income land, more than 50% of actively managed funds can beat a benchmark. So I've used this sports analogy that if you're an equity manager and you're an active manager, you're playing golf. Par is 72. You have to beat the course. That's the index. But if you're a fixed income manager, you're playing tennis. Whatever the benchmark is, doesn't matter. You got to beat the other guy. It's just, you got to beat the other guy. And so the first thing I'll point out is I'm a bond guy. The second thing I'll point out is what I'm arguing is there's true value in active management in fixed income, less so in equities. So the Bianco Total Return Index, we started about 2.5 years ago. And it is our way of saying this is how, so we manage an index. It's the Bianco Total Return Index. BiancoAdvisors.com is the website. We can learn more about it. This index is our way to express how we think a active fixed income index should be positioned. Currently, we're underweight our benchmark in duration, which means that we're betting on higher interest rates. We're bulleted, meaning that we own more in the 5 to 10 year sector than the 2-year and the 30-year sector, meaning we're betting on a steeper yield curve. We own TIPS securities, and that is those are real rate bonds that would benefit from higher levels of inflation. We're underweight corporates because of the stock market's valuation, but we're overweight treasuries and mortgages because we have to be overweight something else as well. So this is the way we've expressed ourselves in our index. WTBN is an ETF run by WisdomTree. WisdomTree Bianco Nancy is its ticker symbol. It tracks our index, much like if I was the head of the investment committee at S&P and managed the S&P 500. I manage the index. SPY tracks my index. So that's the way we're set up. So I'm an index manager, and I manage this index, and I set the parameters with my investment committee. There's 4 people on my investment committee plus me, where we set the parameters where we want to be betting on various things on interest rates, and then we explain it on the website. So we are betting on higher interest rates, a steeper yield curve, more inflation, and an underweight in corporates. In sum, according to Morningstar, there is 470 odd funds in our universe. We finished 2024 in the 19th percentile, meaning that we beat 81% of the funds in our universe. We're playing tennis. We just got to beat the other guys. And so far through October, we had beaten 70% of the funds in our universe through October. So we're playing, and of course, we're ahead of if you were to buy BND or AGG, which would be the broad fixed income indexes. We're ahead of those indexes as well, too, since inception date and over the last year. Our inception date was December of 23. So we're coming up on our 2-year anniversary of running this fund. So that's what we offer. We offer, I think we want to have money in the bond market. I think that but interest rates might go up. It's a complicated thing. I don't understand it. And my answer to you would be, it's good to use a professional manager in the fixed income market. In the equity market, you're probably better off just buying an index because the professional managers can't beat those. And what we're offering is an expertise on professional management of a fixed income asset. The bond market this year is up about 6.5% or so. That's not a bad return for the bond market. I will say, we didn't talk a lot about stocks, but I will say this. We do have an index where we created an index where we take the S&P and we look at the AI stocks and the not AI stocks. There's 41 AI-related stocks. Those stocks are up 23% this year. There's 459 stocks in the S&P that are not AI-related, everything else. They're only up 7% this year, and the bond market's up 6.5%. So it's competing with a lot of investments that are not AI, right? It's competing with cash. It's competing with the other stocks. Gold is way ahead of it. It's definitely competing with crypto because they're down on the year. So it's a viable investment. And we're saying if you want to buy fixed income, then you should consider a professional manager. And that's what we do. We run an actively managed index, and WTBN tracks our actively managed index.
We are running out of time, but this is time for the question we ask everyone. You are a strategist. So let's frame it in this way. What's your best call, the one you are most proud of, where the macro, the charts, and the flows all align perfectly? And on the flip side, what was your worst call, the one that was just humbling, and what was the big lesson you learned from it?
So I'd have to say my best call was probably COVID. January, February of 2020, I was getting deep into the weeds about this virus coming out of China. I was looking at the stocks out of China, the markets and how they were reacting. And I kept seeing the stock market go up. Everybody's saying there's nothing there. And I'm like, man, there's a lot of people dying in China. And there are a lot of markets that are in turmoil in Asia. And I was really worried about that a lot, and that something bad was going to happen. So that was probably my best call that I ever had. And by the way, parenthetically, I remember I do a call for my customers every 3 weeks, a conference call for my customers every 3 weeks. During that period in February and March of 2020, we were doing them daily because there was so much information that we could actually put together a 20-deck slide deck every single day because so much stuff was changing. And I remember during that period that I was really struggling with this. I was like, I have this really bad feeling about the markets. And I said, but I can't short them. And not that I have any problem shorting the market. I said, if I'm going to short the market, what I'm basically saying is I need my neighbors to die of COVID. I need people to drop dead in the street to make this trade work. I can't live with myself saying I will profit if you drop dead. And so I didn't short the market. And it turned out to also be another good trade because I'll tell you about my worst trade. I missed the bottom is basically what happened. So I wasn't exposed to the bottom because I thought COVID was going to be a lot worse than it turned out to be. But the Fed stepped in such major numbers that we had that massive V bottom. We were 35% down in 6 weeks. I never would have guessed. Oh yeah, in 4 months we'll be back at a new all-time high. I thought it was going to take 10 years to be back at a new all-time high. So maybe I got rewarded for having a morality streak that I didn't want my neighbors to die and have a short position because it saved me on the other side of that trade as well too.
That's awesome, Jim. Yeah, Jim. So this has been a masterclass, Jim. So for our audience who wants to get smarter and just reading your work and what you do, where can they find your research and follow you online?
So, yeah, I think a couple of things. We have 2 websites, biancoresearch.com. Take a look at that. Bianco Advisors is our index I was explaining with the ETF. You can take a look at that. Otherwise, under the name Bianco Research, I'm active on social media. We have X page, YouTube. We have an X Twitter page at Bianco Research. YouTube page, YouTube channel at Bianco Research, and on LinkedIn, I'm active under my name, Jim Bianco. That's the only place that it's a little bit different.
Jim, I can't thank you enough. That was phenomenal. Your ability to connect politics, money flow, and decades of chart history is exactly what you are a legend in this business. Thank you for sharing your time and your charts with us. Rafael, thanks for helping me with your big smile.
Yeah, that was grateful to be here, for Jim, for one person that I've been following for a long time. So thank you, Jim. Thanks a lot.
Thank you.
That's all the time we have for Trader of the World. A massive thank you again to Jim Bianca and Rafael Figueiredo. Until next time, stay disciplined and keep connecting the dots. Take care. Bye-bye. Hello, Jim. Thank you very much.
Thank you, and I apologize again for having you guys have to
there's
wait
no
so
problem.
long.
No problem.
Beijo pra
Aí.
Carol. Pede desculpa ter demorado tanto para chegar em casa.
Eu tive que mandar até durante a apresentação, eu mandei uma foto aqui do tipo assim, ó, tô gravando, a culpa é do Flávio.